Hello everybody and welcome to ISTAT Learning Lab. Today we're going to talk about Lessor accounting and tax in times of crisis. And we have two very qualified people with us in the studio in Dublin, Ireland. The first one is Ronan Doyle. He's a partner of PwC and leads their audit services for treasury, cap markets, leasing and structured finance sectors. And Ronan is also responsible for PwC's risk and quality function in Ireland, and as such, a member of the leadership team for PwC in Ireland. And Brian Leonard is also a partner of PwC, and he specializes in corporate taxation of aircraft and equipment lessors. Before I hand over to Ronan and Brian, I want to mention that on the 15th of October, we're going to have Shannon Acker talk about aircraft maintenance and engine maintenance. And this is a rescheduling of the session that we started on the 22nd of September that we had to abort because of a technical problem. And I apologize for that, but we'll try again on the 15th of October. And I hope that everybody who called in on the 22nd can join us again on the 15th. Then on the 20th of October, we're going to talk about the aircraft leasing landscape before, during, and after the pandemic. And we're going to have Norm Liu with us. He's former CEO and chairman of GCAS. And then on the 27th, we have Rob Morris, who is head of Ascends Consultancy, is going to talk about storage patterns in the work fleet. And on the 17th of November, we're going to talk about restructuring with Doug Walker from Seabury. I also wanted to mention that during Brian and Ronan's presentation today, you can post questions in writing by clicking a little round blue button at the bottom of the screen. There is a round button there with two call-out bubbles that you can click, and then you can write in your questions, and I will go over those questions with Ronan and Brian to the extent we have time after their presentation. And also, if you want to make the slides bigger, you can drag in the corner of the slides and enlarge the slides, or with the video frame as you wish. And with that, I want to hand over to Ronan Doyle at PwC in Dublin.
Good morning, good afternoon, good evening, everybody. Thank you, Niels, for your introduction there. And on behalf of Brian and myself, thank you very much for the invitation to speak to the ISTAT Learning Lab today. Over the next hour or so, myself and Brian are going to run through some of the key both accounting and tax topics that we see which are in particular coming to the fore in these times of crisis. 4 from myself in terms of accounting, and then 4 from Brian in terms of tax. As we run through them, we'll deal with some of just the principles behind them, but also just some of the practical implications as we work through them. What I will say that particularly when we're looking at the accounting, obviously with the large amount of different gaps that are out there, by and large, I will confine my comments to International Financial Reporting Standards, IFRS. I suspect that's the one that will impact the majority of the viewership here today. Where there are differences in relation to other gaps, in particular US GAAP, I will mention them. And equally, for those familiar with accounting in the industry, you will be aware that while there are a number of principles that everybody operates to, there is quite an amount of difference which we do see in individual lessors and airlines when they apply the principles. And again, where possible, I might call out some of those differences as we go through. So the first topic I would like to touch on is the topic of impairment. So typically, the impairment has been the most significant judgment that is made in a set of financial statements. But for the last number of years, the historical buoyancy in the market has meant that there's actually been very few impairments recognised as a percentage of the operating fleet that we would have seen come through. And when those impairments have typically come through, they've largely been event driven. So those events may either be industry events, so bankruptcies of Air Berlin or Thomas Cook or others that will have gone bankrupt in the last number of years, or event driven in terms of a lease, where a lease may end up coming back from the lessee. There'll be a large EOL payment at the end, but the future cash flows of that lease are no longer supporting the asset. So they tended to be proportionally quite small, but also tended to be tied to individual events. In terms of how they were done, there was largely agreed formulas in terms of how this worked. One of them involved looking at appraised values, and again, kind of conscious of the audience, I probably won't spend a huge amount of time talking about appraised values, but they were very much one of the linchpins in terms of the assessment of impairment or otherwise. And the second one would have been the discounted cash flows of the first lease and then an assumed terminal value of that lease. All of the impairment calculations have been greatly aided by the very large number of data points which would have been available to us over the last number of years. As we look at the last maybe 6 months, obviously so many things have changed in terms of the comments I've just made there, that there is a rethink of the approach likely to be required. So just in terms of setting a baseline in terms of the objective of impairment, firstly, aircraft on the balance sheet are not carried at fair value. So when preparers, accountants, auditors are looking at the value of the aircraft, it's not a fair value they're looking at. What they are looking at is to whether there has been what's called a trigger for impairment. And if there has been a trigger for impairment, how to calculate that impairment. So effectively, it's a two-step test. Step one, have there been triggers? Step two, how do you calculate the impairment when there has been? The identification of the triggers is therefore critical in terms of any assessment view of the first one I would note is the either announced changes in flight routes or early retirement of certain aircraft models. So again, one of the triggers will be whether the particular aircraft involved is an aircraft that is either in or out of favour at this present time, or whether it has been announced that will be either early retired either from a fleet or the industry has identified it as a potential early retiree overall. So that'll be number one. I think number two, which will be contract specific, will be if there's been a rent concession or a deferral granted, where the cash flows coming out of that rent concession or deferral are significantly lower than earlier forecasts. So again, that would make sense because these are largely discounted cash flow calculations. If concessions or deferrals are granted, that is likely to impact any calculation of impairment. And then the third one would be if there's any cause for the lease to be returning, particularly if there's a cause for the lease to be returning early. So the purpose of the triggers is to identify which aircraft are likely to need the mathematical calculation. When we then go to the mathematical calculation, it is possible to calculate both fair value less cost to sell and value in use. And typically you use the higher of those two numbers as being the number for the purpose of your impairment. As I would have said in my opening comments, both of those calculations are very heavily reliant on reliable data points and data points which are current and likely to reflect what is achievable in a market. The fair value less cost to sell, that is typically which has been anchored to external valuations. And just a small number of comments there, if I may. So in terms of what we would typically have seen, those external valuations could either have been generic, so a 2015 A320-200, or asset specific. Clearly, asset specific has far more information value in it. But in some cases, the generic, particularly for younger aircraft, have been considered to be appropriate. The second aspect would be it's typically base values rather than market values, which would have been used. Again, the base value being more the reflection of the longer term value in the asset. This is a calculation of what an asset is going to generate over a 20-25 year period. So base would be more appropriate than market. And thirdly, would tend to be the non-inflated number, although certain people would look at an inflated number. On the whole, it would tend to be a non-inflated number. I guess as we go into the future reporting and future calculations, the questions that are going to arise are typically going to be the reliability and integrity of those calculations, and to what extent any particular caveats need to be called out, whereby just the uncertainty that is caused by the current conditions are bringing uncertainty along. The more common approach or more used approach tended to be what's called a value in use calculation. And a value in use calculation is the specific assumptions and techniques that a lessor would actually apply in terms of calculating the value of its fleet. In terms of that value in use calculation, it is a discounted cash flow. However, for reporters under US GAAP, it is actually a two-step approach. So before you actually get to the discounted cash flow, you have what's called a gross cash flows test. And that test, as suggested on the tin, is actually looking at whether the gross cash flows are in excess of the carrying value of the asset. If they are, you would actually stop at that point. So it has often been said when comparing US GAAP to IFRS that you tend to have impairments on IFRS sooner than you would under US GAAP, because the US GAAP involves this gross cash flows test, whereas IFRS effectively doesn't have that within its particular set of criteria. So you go straight to a discounted number. By and large, the rest of the calculation would be the same. It's just the impact of discounting. And clearly, if there are cash flows early in a lease which are impacting that, the impact of discounting could be significant. Just in terms then of what those assumptions are, and again, just to give a bit of a flavor in terms of just what we've typically seen and how we might expect that to move. So the typical assumptions that are used, I've just listed there on the slide. In a pre-COVID world, there was a reasonable consistency in terms of how these would be interpreted. So release rates were generally set as being a percentage of the current lease rate, be that 75%, 80%, 85%, based on the type of aircraft and the age of aircraft, particularly if there wasn't a future, a next lease lined up. The downtime assumption, again, tended to be somewhere in the region of 0 to 3 months. Again, very much driven by the buoyancy that was there and the ability to place particularly the popular aircraft easily in the market. Transition costs tended to be small, a couple of $100,000, again, as a generic assumption. And maintenance cash flows were either not brought into the calculation, or when they were brought into the calculation, were brought in reflecting just the large events which were known to be happening and the timing in which they were going to happen. Residual values, as I said, generally came from the appraisees, or if the lease was expected to run out all the way to the end of life, a de minimis amount, and then we had a discount rate. To my mind, this is probably the area that will have the biggest amount of variability between different practitioners, and also the greatest amount of kind of judgment and investment that is going to be needed in terms of putting them together. So again, if I look at some of them, and not to go down fully through the list, but release rates, there will be a need to probably look on a aircraft type by aircraft type specific basis as to what an appropriate release rate is. Potentially that may also need to actually tranche the aircraft across different ages, so new aircraft, midlife aircraft, end-of-life aircraft, to build a far more granular matrix as to what a release rate is likely to be, particularly when you're dealing with a second lease and maybe a third lease. So I suspect there will be a significant change there. Equally, the assumption around downtime, I'm expecting to see that extended out quite considerably. And obviously in a discounted cash flow model, the amount of downtime you have has the impact in terms of the discounting, which can make a difference depending on the assumption. Probably the two areas that I would expect will have the biggest amount of difference compared to the previous is the treatment of maintenance and the treatment of residual values. And in particular, how assumptions are going to be factored into impairment to reflect the fact that aircraft are not likely to be flying the same routes that they were particularly flying, have the same utilization that they were particularly flying, and will have potentially extended periods of downtime. What that will be able to do for maintenance flows, both flows in and flows out, the timing of those and the quantum of those would need to be factored in, as will ultimately what the residual value either at the end of the lease or at the end of the life of the aircraft is likely to be. Final point just to touch on in relation to the assumptions is the discount rate. And in relation to the discount rate, it is a risk-adjusted discount rate that is required, often referred to in corporate finance as being the WACC, the weighted average cost of capital. So it's not purely a debt cost, it needs to be a debt and equity cost. And this can, in a number of cases, be difficult to actually derive, particularly if for lessors who are not active in the capital market, so therefore may not have a current debt rate and or will not have a observable cost of equity. I think it goes without saying, probably the expectation is that the discount rate is likely to be going up, just reflecting the risk premium that we'd be observing in the market at the moment. We do expect that people will be looking at multiple scenarios, and in particular when assessing aircraft which may or may not remain on lease or may have a number of different potential uses. So historically, the calculation would tend to have been done with a main scenario and not looking at alternatives. We would expect that alternatives will start to be considered as people are looking at, it isn't necessarily the number one option that may be followed. It may be plan B or plan C. Finally, in relation to impairment, the requirements of all gaps do require you to make disclosures of the material assumptions, which does mean that there will be quite an amount of information out there, particularly for lessors who have either March or June year ends, because they will actually be disclosing some of the key assumptions. And in particular, the ones which to concentrate on are the ones that, had they been adjusted by reasonably probable amounts, would have created an impairment. So I guess just to sum up on impairment, if I were to kind of maybe identify just a couple of actions, I think the first one is to get an understanding of the triggers, because that's the source and the entry into the rest of the impairment test. The need to spend time on assumptions will be very important, because certainly the past will not be a reliable measure of the future, and in a number of cases there will not be a right answer in relation to the assumptions. The importance of considering scenarios, particularly given the volatility and the uncertainty that's out there. And finally, just in terms of the quantum and granularity of the disclosures, both in terms of a source of information as to what others are doing, but also in terms of impairment itself and where potential variability in early warning signs may arise. Okay, just the second point I just wanted to touch on was intangible assets. And there is quite a diversity in practice in relation to intangible assets and the creation of intangible assets. These tend to have different names depending on what you're looking at. So you have a maintenance right or a lease premium, a lease discount, maintenance intangible, but predominantly it is where an asset has been created for a contractual condition that is in the lease. As I say, it's an accounting policy, so it's not universally followed. However, where those intangible assets have been created, it's critical to remember that they also need to be part of an impairment review. And in relation to this, and these numbers can be quite substantial, the key questions that would be asked is, well, what is actually driving the value of that intangible? So what created it in the first place? And whether that expectation is still expected to happen, either because the lease is now being renegotiated, the terms of the lease have changed, the lessee has signaled that they may not be able to perform because they've gone through some form of Chapter 11 arrangement, etc. So this is quite a complex area, not least because there is a large number of different accounting policies, and actually how these ultimately end up getting taken to income can differ. Because when we're looking at an impairment review, really what we're doing is we're accelerating the taking to income of a particular asset that is on the balance sheet. I would say in relation to intangibles, the particular areas to look out for is where there have been modifications or expected modifications of leases which impact the arrangements in relation to maintenance, either moving from an MR to an EOL, or where potentially the terms, the redelivery terms, are going to change. They are likely to be the triggers in this particular area to keep an eye out for. My third area just to touch on is credit provisioning. So in terms of value of the debtors. And again, we've a bit of an alphabet soup here of GAAP that could potentially be followed, depending on what the underlying is. So for those on IFRS, we are on what's called IFRS 9. And IFRS 9 is an expected credit loss standard, but it is graduated in that you start with an expected loss over 12 months. And if you have what's called a significant increase in credit risk since origination, you then move to lifetime. So that is effectively a two-step expected loss model. By contrast, US GAAP ASC 326 is a current expected credit loss model. So it's actually the second stage of IFRS 9. So again, comparing two reporters to each other and assuming there hasn't been a significant increase in credit risk, you will probably have a higher provision under US GAAP than you will under IFRS. And then the third model, just again, conscious of the fact that a number of lessors report under Irish GAAP, is the old IAS 39 model, which is an incurred loss model. So until you are reasonably sure that you've actually incurred the loss, you would not actually be making the provision. The key thing to watch out for here, firstly, is just what particular principles and GAAP you're actually under, but also what the treatment of security deposits and maintenance reserves is. And that has two important dimensions. The first one is reflecting the fact that you are probably not fully exposed to the full amount of the debtor to the extent that your lease agreement allows you offset certain deposits and other items against that debtor. So in terms of calculating the actual provision, the understanding the security deposits, and in particular the legal rights and obligations in relation to those security deposits is important. The second point is just to be conscious of the fact that where the debtor relates to unpaid security deposits or maintenance reserves, it's just important to consider whether it continues to be appropriate to actually recognize those security deposits and maintenance reserves as security if they have not yet been paid in cash. So it's just an inflection point just to consider, particularly when you're looking at the nature of the debtor, just what is that debtor made up of, and in particular, are there items of security which may suggest that the security package is more robust than it otherwise is because the amounts are in debtors. Last point I would make just in relation to credit provisioning, and this tends to be more specific to US GAAP, albeit there is an accounting policy choice under IFRS, which is how do you recognize revenue when the probability of collection is not probable? So at its most extreme example, if you have a lessee, which is in Chapter 11, the recognition of, so effectively under IFRS, you would have two options there. You could either recognize the income and then immediately provide for it, or you could suspend the interest and suspend the rent and put it on cash accounting. US GAAP, by contrast, the US GAAP standard does include a provision that where the recognition of revenue is not probable, you are required to go on cash accounting. So as we go through our differences between IFRS and US GAAP, potentially this is an area of difference where US GAAP reporters will be switching off accrual accounting earlier than IFRS reporters because of the requirement under US, which gives you the accounting policy under IFRS. The last area I just wanted to touch on before handing over to Brian was the area of lease modifications. So renegotiation of leases, this is proving to be a very complex area. Number of things driving it. I suppose if I were to pick out a couple, it's the bespoke nature of the agreements. It's the fact they tend to be linked into the lease agreements themselves and the nature of those. And also there are a number of cases where the lessees will actually be seeking their own particular accounting. So they may be looking for a particular way for the agreement to be structured. Depending on the way the renegotiation is done, you can almost end up in three different outcomes. It can either be a continuation of the lease. So probably the example here I would use would just be a deferral of rent. So you're still getting the same amount of rent. You're still getting the same amount of rent over the same period. It's just being paid in different installments. You can have a modification, whereby the modification would require you to effectively restart your calculation of the straight line rent. So if you have a step up lease, a step down lease, or any lease which doesn't have linear flows, you would need to treat that as a effectively a new lease and recalculate the straight line. Or in its most extreme, you could have a derecognition of the existing lease and a creation of a new lease. And what that triggers is that triggers not only the recalculation of the straight line, but you also potentially need to write off any other items that would be on the balance sheet, and you need to reassess whether you have a finance lease or an operating lease. I would say at this point, there's probably no rules of thumb or bright lines that have necessarily emerged. They are very much based on facts and circumstances. But the key question in relation to the modification is around the economics of the lease, and in particular, whether there has been changes in the gross cash flows and also the net present value of what has been the before position and the after position. The last thing just to say on modifications, particularly where you've got modifications which are deferrals, is it's just important to also reflect the fact that loan loss provisioning from my previous slide will also impact as you are going through that assessment, and particularly looking at these balances that are building up. So at this point, I'm going to hand over to Brian, and as Neil said, we'd be happy to take questions at the end of Brian's session.
Thanks, Ronan, and hello all. Maybe before just tucking into some of the topics that I plan to cover in the tax piece today, just to touch on a couple of the overlaps. And obviously these comments are with respect, broadly to the IFRS accounting and the corporate tax treatment that one would expect to follow from that. So firstly, in relation to revenue recognition, to the extent that there's an adjustment in the manner or the straight line, accounting for lease income through the income statement, that would be expected to be followed for tax from a tax perspective. Equally, where provisions are required, certainly under IFRS, those provisions need to be specific, and if they are specific, would likely be allowable for corporate tax purposes. And then finally, with respect to impairment, as ever, to the extent that there is a requirement for impairment, that those impairments would not be allowable from a corporate tax deductibility perspective. So they're probably the three headline tax comments that I would layer on to the topics that Ronan has covered. So maybe then just to try to set the scene for what we'll try to do over the next half an hour. In the first instance, I should just introduce the fact that Gavin Neary, who's the head of tax at Avalon, has very kindly agreed to join today to cover the topics that I intend to do. And hopefully Gavin is seeing it from the inside of a large leasing company with a diversified portfolio, and share the benefit of his experience from a practical perspective and insight. And the intention today is very much to give or provide an overview of what we see as the headline issues in the industry, and to illustrate those in a practical way. So I'll certainly call on Gavin to share his own experience. I've picked four topics, and maybe before getting into each of those topics, just to set the scene in terms of why international tax is so critical, or such an integral part of aviation finance or aircraft leasing. I would say more so than almost any other industry that's out there. And it really comes down to the fact, two principal elements. One is that the parties involved are so multi-jurisdictional. So if you take any basic leasing arrangement, you may have a lessor based, for example, in Ireland. You may have an airline in Asia. You could have a senior debt financier in the US or in Europe, or in Asia. And indeed, you could have investors from a combination of territories. And within that sort of composition, you have cross-border lease payments, you have cross-border interest payments. So by definition, it's about as diverse from a geographic perspective, and therefore you're dealing with multiple tax codes across those jurisdictions. The other main reason why, and probably the primary reason why it's so diverse in terms of its the issues that need to be considered, is the fact that the asset itself, which is the aircraft or the engines, which have such a high value, are mobile. So most other industries, you're dealing with assets that are immobile, certainly assets of a significant value, or have a very clear nexus in one particular jurisdiction, be it real estate or stocks or shares or otherwise. Whereas the assets themselves move around, and therefore when they're being transferred, their location is critical. Where they're being operated from, where they're being flown into, can dictate tax nexus. And then obviously on top of that, we have the fact that tax law is constantly changing by reference to local revenue or indeed policy moves at a government level. So what we're trying to do then is in the agenda cover 4 topics, invite certainly Gavin's perspective on each, but I'll sort of set the scene in terms of what we see as being the fundamentals of 3 areas, in particular, withholding taxes, indirect taxes, and corporate taxes, that are fundamental to both the structuring and the implementation of leasing transactions. I will then cover certain COVID considerations. COVID itself has probably not fundamentally altered how we look at tax. It has probably given rise to certain features in the industry in terms of assets being on the ground and or people not being as mobile, which has heightened certain tax risks, and we'll touch on those. So maybe just to kick off then with withholding taxes, and I'm sure anyone who's in the industry will be aware that it's really the single biggest issue that comes up in any single biggest tax issue that comes up in any leasing structure, or indeed any contractual discussion with respect to tax risk and tax representations. So maybe just touching on some of the elements before we get into sort of a kind of a current structuring conversation or debate. So withholding tax at a very basic level is a tax which is withheld by the airline or the lessee in relation to a sum of income, effectively. So the lease rental being the sum of income, and the rate that can apply, and the reason it's so significant in leasing context is that in the first instance it's applied to a gross payment, the lease rental payment, both the base rental and in most instances the maintenance reserve payment. And the rate that applies, although it varies in different countries, the base rate is generally upwards of 20%, and often in the case of the likes of Italy at 30%, or India in some cases at 40%. It can be it's clearly a very material element if the intended outcome or the structuring elements don't go to plan. I think that's why there's such focus on the gross up clause within lease agreements, which generally speaking provide that the lessee is the party that's responsible for any withholding tax should it arise, and indeed bearing the cost of it. However, in terms of risk sharing, I think we would say it's increasingly an area of dialogue and scrutiny between a lessor and an airline, particularly with respect to the lessor making certain representations with regard to their entitlement to qualify for a tax treaty, because qualification for a tax treaty often will either eliminate or significantly reduce that rate of withholding from 30% down to 0 or close to 0. So for that reason, and for the fact that in recent years and going forward, we've had the introduction of a principal purpose test into most tax treaties, which we'll touch on, which is really a commercial purpose test in tax treaties. It's led to quite a level of to provide them comfort in relation to in relation to the withholding tax position. So in terms of withholding tax and exemptions and tax treaty analysis itself, I think the simplest way to explain this is that the basic position falls into probably one of three categories. So either you have a territory which doesn't, in the first instance, apply a withholding tax, and whilst there are not that many countries like that, but there are some, UK, UAE, Ireland, in fact, is an example of that, where under first principles there just is no withholding tax. And if that's the case, then clearly the tax risk and the implementation of that is more straightforward. You then secondly have a group of countries where a domestic exemption from withholding tax might be available, either by virtue of a national flag carrier specific exemption, or an exemption which is afforded to airlines which operate internationally, or which are indeed considered to be public service entities, like specific exemption they have in Portugal, the likes of TAP can avail of. So you do have a number of jurisdictions that fall into that type of a category. However, I suppose the largest category, and the reason why tax treaties are so critical to both the structuring and the implementation of leasing arrangements, is the vast majority, or certainly a large proportion of leases will fall into a category whereby tax treaty relief will reduce or eliminate the withholding tax that's suffered. And tax treaties are although they're modelled on a single, or for the most part, a broad template, they do tend to differ. They've evolved over time. Some of them are older. They get updated. So in short, in respect of withholding taxes, the reason they can be quite complex is that tax treaties don't include or prescribe a specific article that relates purely to lease or aircraft lease income. They have a number of articles within which the definition of leases or lease income or lease payments could fall. Be they, for example, a royalty, which is a payment for the use of equipment or industrial equipment, be they an interest payment, which finance leases may fall under, be they considered a payment or income earned in respect of international transport, or indeed if it falls under neither or none of those first categories, it can fall into the definition of business profits. And in short, depending on the definition of lease income in a particular treaty, withholding tax may be eliminated, or it may be stipulated at a certain rate, a la the royalty article in a tax treaty. I suppose just to extend that comment, I mean, in terms of the need for careful reading of a tax treaty, the best example of that really is that whilst an analysis might be arrived at in relation to aircraft lease rentals, there can be differences for engine lease rentals. So the best example I probably have of that is with regard to aircraft lease rentals from Ireland to India, which are exempt or clearly exempt under the Irish Indian Treaty. There are instances whereby engine lease rentals may not be exempt under that same treaty, and a withholding tax of 10% may apply. So I suppose that's probably the reason why, when it comes to structuring, both from the perspective of qualifying for a preferred rate under a treaty, and then going back or revisiting the principal purpose test issue, and indeed by extension, a number of territories have developed what's called a beneficial ownership doctrine, or a focus on the concept of beneficial ownership. And really what that amounts to is a lessee tax jurisdiction or tax authority seeking to potentially focus on whether or not the recipient of the payment, the lessor, is the true beneficial owner of that payment. And if they are, allowing the treaty benefit, and if they deem them not to be the true beneficial owner because they're just a mere conduit, or they have an obligation to directly pay on that income to another party, then seeking to challenge that they're entitled to the benefits of a tax treaty. And we've seen that focus on beneficial ownership pre-exist the introduction of a commercial purpose test in tax treaties, but really acting side by side in driving dialogue with or between airlines and lessors in terms of pushing lessors to prove out that they are entitled to tax treaties. So that's a dialogue that, in particular, the likes of Korean Airlines, Chinese Airlines, Indian Airlines, in Europe, Italian Airlines have pushed and picked at very hard, and has led to a significant level of both dialogue and proving out the representation piece of entitlement to tax treaties. Maybe that's a good point to seek to bring Gavin in on and look for some of the practical experience that he may have in this area. I mean, maybe just to flag up, Gavin, I know there's some domestic areas that we've seen change of law introduce additional risk for lessors, but I think you've also some practical experience of what this principle, the introduction of this principal purpose test has led to, particularly with regard to some of the intermediary leasing structures that were traditional for certain jurisdictions.
Thanks, Brian. Yeah, withholding tax is undoubtedly a big concern for the lessors, as it applies in the gross rentals rather than the net profits. So it can be a very material cost if exemptions or reliefs aren't available. So as you mentioned, the withholding tax, it's typically an airline risk, as airlines should cover all the costs relating to the use and operation of the aircraft. And the lessors, they should be protected, as you said, through the gross up provision. So basically, the lessor should get paid irrespective of whether foreign withholding tax in lessee jurisdiction applies or not. But tax laws are continuously changing, particularly in the current environment of international tax reform. And lessors, they're finding it increasingly challenging to manage these changes in certain jurisdictions. So some examples are Brazil. There was a domestic withholding tax exemption which Brazilian airlines relied on. But that's now expired and not yet renewed. So from the 1st January 2020, Brazilian withholding tax at the rate of 1.5% applies to lease rental payments from Brazilian airlines to non-Brazilian lessors. So obviously, this is the worst possible time to introduce a new tax to Brazilian airlines due to the number of airlines in this region entering into a restructuring process or a Chapter 11 process during COVID. So the airlines are already under significant liquidity pressure, and any additional tax is going to increase risk of failures. Other examples of jurisdictions that we're finding challenging from a withholding tax perspective are leasing into Australia and Japan. That's because we're an Irish-based lessor owning our aircraft mostly in Ireland. So the OECD has introduced changes to international double tax treaties, which means that certain traditional intermediary structures used by Irish lessors to lease into Australia and Japan to mitigate the withholding tax are no longer viable. So we're seeing a lot of lessors now changing ownership of aircraft from Ireland to jurisdictions which have good treaties eliminating withholding tax. So US for leasing into Australia and Hong Kong for leasing into Japan. But as you mentioned earlier on, one of the key requirements under the new international tax rules for availing of treaty relief now is that the lessor has to have employee presence and substance in the jurisdiction where they're leasing from. So this can be challenging for some lessors, particularly the serviced platforms such as the ABS or JV structures that don't have employees in their own right, but rely on management of the vehicles by other operators. And just lastly, China is another jurisdiction where withholding tax does apply on payments of rents to foreign lessors. So we're seeing a lot more interest now in the China free trade zone structure, which can help mitigate this withholding tax cost for the Chinese airlines.
Thanks, Gavin. So hopefully that gives people a good flavour of the current challenges that exist in relation to ensuring that that withholding tax is mitigated to the extent possible. So, but we'll probably move on to the next topic, which is indirect taxes. So be they VAT or goods and services taxes that can apply to both the transfer of aircraft and the leasing of aircraft globally. Again, we're not dealing with a uniform set of rules, but for the most part, I'll talk to some of the common principles that generally will apply across jurisdictions. Again, this is the risk area and a headline risk area because you're looking at significant tax rates applying, upwards of 20% for VAT and GST in many jurisdictions, and those taxes applying on gross amounts, so be they the transfer market value of aircraft or the lease rental payments themselves. What I might just focus on for the most part in terms of indirect taxes is transfers of aircraft, because that's what probably commercially is what gets most focus, effectively in trying to ensure that there are no transfer taxes on the purchase and sale of aircraft. for the most part, the nexus in relation to any transfer tax applying is driven by the location of aircraft at the time the title itself of the aircraft transfers between a buyer and a seller. So if an aircraft is in a certain jurisdiction, it tends to be, have taxing rights for indirect tax purposes. However, that's not always the case, and one strong example of that is Japanese consumption tax, which can apply notwithstanding the aircraft may not be in the country at the time of transfer, but may remain on a Japanese register when it's transferred between two non-resident entities. So it's not always by reference to the location of the asset that an indirect tax applies. The location of the aircraft point, though, I think is worth just spending a moment on, because although an asset may be in a particular country, that doesn't necessarily mean that it falls foul of its absolute indirect tax rules. There can be in certain jurisdictions, bonded warehouse regimes or free trade zones, and in many instances these bonded warehouse or free trade zones may be adjacent to or part of airports, which can facilitate tax-free transfers of aircraft and engines. Equally, I know people are probably familiar with the concept of international airspace or international waters for efficient transfers of assets. And often one needs to look at exactly what that definition of international waters is. In many instances, it's by reference to 12 nautical miles from territorial land. There's a couple of additional points. I mean, in terms of managing the taxation or transfer taxation of an asset, an aircraft, or an engine, where it is in a jurisdiction which applies a VAT or a GST to a transfer between two non-residents or otherwise, there's probably two core exemptions that tend to apply. In the EU in particular and elsewhere, there's a kind of a broad-based exemption that can apply with respect to an aircraft where it's operated chiefly for reward on international routes. So if the aircraft is operated by an airline which operates internationally, then an exemption can apply. One small thing to watch there, that not in every jurisdiction that exemption doesn't necessarily extend to engines in the same way that it again extends to aircraft. The second sort of main exemption that can be facilitated or can facilitate tax-free transfers is what's referred to as an export exemption. So notwithstanding that an aircraft may be transferred or title may transfer while it's in a country that has a tax or a VAT on transfer, if there's a commitment to move that aircraft permanently out of that jurisdiction post transfer in an unaltered manner, that's an exemption which is widely utilized within the EU, for example, if the aircraft is acquired and then is going to be moved out. So often that crops up in the context of aircraft that are not on lease, let's say. So that's worth watching out for. In terms of the liability for transfer taxes, it's mostly the case that they fall both contractually and actually from a tax perspective with the purchaser. But clearly the seller has to be comfortable with understanding what the appropriate treatment is in terms of an exemption applying and what they might need to do in terms of filing that exempt sale. And indeed, because in many instances the seller is secondarily liable, so if the purchaser was to not pay the appropriate tax, the seller can become liable to that VAT or GST. Maybe just to mention before touching on or maybe just before moving over to Gavin to get some of his practical experience of dealing with assets that are flying around, or for the most part are flying around in the air. And having to try to deal with the nuances of transfer taxes from a practical perspective. Just to say that customs and import duty, although not applicable to sales as such, are an issue that need to be handled with respect to movement of aircraft around, particularly if aircraft are moving into operation into a new territory. And for the most part, it's the lessee, the airline, that's responsible as importer of record for dealing with those customs or import duties. But I suppose we're seeing, particularly at the moment with the volume of aircraft owned by lessors and on the ground, that's an issue that lessors are coming to us frequently or more frequently on. So, Gavin, maybe just to turn to you and to share any of your own sort of practical experience on the transfer tax side.
Yeah, again, depending on what's contractually agreed, typically the buyer is responsible for taxes arising on the sale of the aircraft. However, there's usually a clause where both parties have to agree on the delivery location in order to manage the tax cost arising in the jurisdiction where the transfer title takes place. So, as you mentioned, delivery can usually be managed while the aircraft's on an international flight or in a jurisdiction which doesn't apply taxes on the sale of aircraft. However, it's not always that easy, and we've had problems selling aircraft that only operate on domestic routes, for example, regional jets. We've also encountered problems during the lockdown where the airspace was shut down. So the main problematical jurisdictions for trading aircraft are China, Russia, Australia, and India, where sales tax or GST will apply in the transfer. And for some of our recent ABS transfers, which happened during the lockdown, we had some interesting discussions with the lawyers on what constitutes international airspace in the Philippine archipelago and the Black Sea. And ultimately, we had to delay the transfers to when airspace opened up again. So I think the key message is transfer locations are usually manageable, but they can sometimes delay the timing of the transfer.
Great, thanks very much. I think in the interest of time, I won't spend a lengthy time on the indirect tax piece of lease rentals. Maybe just to make a couple of headline distinctions. Although, as I mentioned, the nexus for transfer tax is largely by reference to location of an aircraft. Indirect tax, as it relates to lease transactions, that's generally made or sourced to the country in which the lessee operates, so the airline, and for the most part is accounted for by the airline. Not always. So you have, in the case of, say, South Africa, where there's still an obligation on the lessor to be the party to account for VAT or GST, and equally in Canada, where a non-resident may be considered to be carrying on a business if it has both acquired and delivered an aircraft under lease. It has an obligation to register and file, but for the most part, that obligation under lease is a responsibility of the lessee and is sourced by reference to the location of the lessee as opposed to the location of the asset in the case of a sale. Maybe just in the interest of time, moving on to corporate tax developments, and I suppose we could spend a whole session talking about the corporate tax developments that have impacted the international tax base over the last number of years. And very briefly, the background to this goes back to the start of the last decade, where there was a really strong collective push at G20 and OECD level to tackle what was perceived to be, the abuse or abuses that were ongoing with respect to tax planning at multinational corporate level. And on foot of that, the OECD were charged with coming up with an action plan to target, a number of these perceived abuses. They weren't in any way focused at the leasing industry, but were pretty pervasive in terms of what their impact or intended impact was, and as a result, a number of their actions that have come into play, including the introduction of the principal purpose test that we've mentioned in tax treaties, have had an impact on the industry. And I want to just touch on one or two of those. Maybe just to we'll go through each of these, but just to provide a bit of context to really what collectively what the themes behind a number of these initiatives were focused on. They could probably fall into two broad categories. The first being the issue of substance, so the theme of substance, and substance gets bandied around as or it's used as a term quite a lot in a tax context. But in short, what it means is requiring companies to align the taxes that they pay or the profits that they subject to tax in the same jurisdictions as those profits are created through either functions, i.e. people, their assets, or indeed the risk that's carried. So that whole idea of ensuring that people have the appropriate substance in the jurisdictions that they're booking taxes is pretty paramount through a number of the BEPS initiatives of the OECD, base erosion and profit shifting initiatives, which have now become part of domestic tax law and tax treaty law over the last number of years. The second theme, really, which is driven or has been central to a number of these initiatives, is the theme of transparency. So, whilst historically there was a pretty limited level of coordination between tax authorities, so they didn't have great visibility in one country as to what taxes were either paid, what activities were ongoing for a taxpayer or a taxpayer group in other jurisdictions. I think BEPS and the transparency that's come through the transfer pricing initiatives over the last number of years has transformed that, in that now large taxpayers for the most part are obliged to report to their home taxing authorities with respect to both the tax profile they have in their countries and in their particular country, and indeed that information is shared between tax authorities globally, so that each has or is able to build up a tax profile, a global tax profile of the taxpayer, and get much greater transparency around what cross-border transactions are happening and where taxes are actually being paid or not, as the case may be. And that's allowing a much greater level of scrutiny and effective audit. I think that's a tool. The aid of transparency will certainly help people, or certainly aid tax audits in the years to come. So probably just to pick out two or three of the headline corporate tax developments, the specific ones that have impacted, for sure, the introduction of a principal purpose test, and the impact of that Gavin has highlighted. It's put really a stay of execution on or it's put an end, I should say, to intermediary leasing structures for the most part. And indeed, any low substance owner structures that investment funds may have previously deployed are under significant pressure now. So the need to have people in the same jurisdiction as you book your profits is a fairly fundamental principle. Secondly, and it's referred to as I suppose the interest deductibility or interest capping, and we've seen this come through the BEPS initiative, but being adopted in both Europe, the US, Japan, really limiting the ability for taxpayers to use interest or debt as a means to reduce their tax bills. And for the most part, the action that's come in is that, or is being brought in, is that it's capping your ability to take a deduction for interest at 30% of EBITDA, 30% of earnings before interest tax and depreciation. And that's going to have, no doubt, an effective tax rate impact. And depending on the precise nature at which it is introduced, but we've seen it have an impact in Japan already, in the US. The rules have not been introduced, although they've been introduced in Europe. They're yet to be introduced in Ireland, but will be from 2022. And for lessors, that'll be something that needs to be examined closely, or the detail of which needs to be examined closely. The final area of transfer pricing, I think I just reiterate that that practical ability of tax authorities now to build up a picture is allowing them already to start to challenge certain group structures where assets may be and profits may be booked in one territory, where a lot of the origination and the servicing activity and the high level elements of that are being carried out in another jurisdiction. And you see those jurisdictions of the servicing, origination, the value add activity challenging that larger attribution of or level of profits should be taxed in those jurisdictions. I suppose, what does all that mean? And Gavin, I might look to you for your own perspective on this as an actual lessor. I suppose what we see this trending towards, certainly from what we see at PwC, is clearly a trend toward increased effective tax rates. It's harder to implement quite cynical tax mitigation strategies. You've seen it through the impact of the likes of an interest cap. I think we're going to see effective tax rates rising over time. Secondly, I think the likelihood of tax challenge happening with that greater visibility is just, I think we've already seen it with the likes of particular territories from a lessee perspective, India, Korea, etc. And I think thirdly, then, to the extent that it all hasn't already happened, and it probably is something that's reflected in mainstream lessors, but less so in the investment funds that have come into the industry, the need to have robust substance in the location that you're booking your profits is something which is just going to become more part of the norm rather than the exception that it was in the past. So Gavin, I don't know what it's been like to be on the receiving end of some of these initiatives, but maybe share your own perspective.
Oh, no, just very quickly. I mean, I agree with all of that. I mean, I think we're going to see lessors having multiple aircraft owning regional hubs now to manage the withholding tax. As mentioned previously, there's going to be a requirement. If you have a hub somewhere, you're going to have employees in substance. So it just means there's going to be additional administration costs. But given Ireland has such a favourable tax regime compared to its competitors, it's going to result in higher effective tax rates and potentially more cash tax payable by the lessors.
Cool. Thanks, Emil. Maybe just finally to finish with pointing to a couple of the features of COVID that we've seen raise or alter certain tax risks. The first one being the fact that it has led to certain sort of stressed renegotiation or restructuring discussions, and given the profile that we've spoken about of some legacy lease structures, be they intermediate lease structures or low substance lease structures, or indeed just the need to revisit older leases where some of the tax indemnity language has probably become slightly outdated by changes in tax law. The fact that those commercial discussions are happening has probably triggered a point to open up that consideration or dialogue around tax risk, and as a result, we're seeing increased dialogue on the tax risk sharing provisions in leases. Secondly, then, with respect to both permanent establishment, which is the idea that a lessor party can create a taxable presence in a jurisdiction outside of its own country of residence, and indeed tax residence itself. I think we've seen both of these risks been heightened by the fact that there's been a restriction on people moving around, and that's resulted in one of two things. I think either there are people now that have been based in jurisdictions that they normally wouldn't operate from because they've either moved home or been restricted from traveling back to their country where they normally operate, and that in itself, if they are binding the company contractually, potentially gives rise to a risk of a taxable presence in that particular jurisdiction. And on the tax residence side, more of a practical issue, as people are probably aware, when it comes to ensuring tax residence of companies, the board meetings are a fairly fundamental tenet of that, and the participation of board directors at those board meetings in country is a fairly rudimentary rule of thumb for ensuring robust tax residence. And obviously, if people are prohibited from traveling to board meetings, then certain consideration around those arrangements needs to be given to ensure that the company itself is or maintains its tax residence in its intended jurisdiction. And finally, I suppose a feature of the fact that aircraft themselves are not as mobile as they normally are. There are more aircraft in storage in territories that they may not ordinarily be in storage, and if there's a volume of aircraft and a volume of activity in that particular territory around that storage activity, one might need to consider whether or not there is a level of or a potential for a tax presence being created in or around that storage activity. And then secondly, the fact that aircraft are not in operation makes the point that Gavin was making around ensuring you manage the location of the aircraft at the point of title transfer just more practically challenging. So if an aircraft just is off lease and is not intended to be in operation, the flexibility around managing its location is just become a lot more challenging. So I suppose there was, in short, some of the practical challenges that COVID has thrown up. I think maybe conclusion, just to before we open it up to questions and back to Niels, to say hopefully that's provided you with a very quick but headline flavour of the issues that continue to keep everyone attentive and active from a tax perspective in the aviation leasing space. And maybe just again to say thanks to Gavin for joining and sharing his own personal experience. I think that hopefully helped to provide a more in-house flavour to things. So Niels, maybe back to you for any questions that have come in.
Yeah, Well, thank you, guys. You were quite exhaustive here because we don't have a whole lot of questions, but we have a few. The first question is from Carlton Ling, who is with Signature Global Asset Management. And he's just simply asking, are the slides going to be available? And they will be available. Visit istats.org's website for further details, but the slides will be made available. The other question is from Vilius Lukasiūnas. So he's a finance manager of Avion Express in Lithuania. And he's asking with respect to IFRS 16, now, what is the accounting impact if, for example, a lease has its rent deferred for, say, 6 months? What happens in terms of impairment and income recognition, both on the side of the lessor and the side of the airline? So I think that was a question for Ronan.
Thanks, Nils. There is a recent expedient under IFRS 16, which is applicable to lessees only. And what that says, it came out probably June, July time. What that says is that if you meet 3 criteria, you don't have to look at whether your lease has been modified or not. Those 3 criteria are actually quite specific. So one is that the revised consideration for the lease is either the same or less than the previous arrangement. So effectively, you can't have large increases in the lease rent put in. The second one is that it only applies to payments which are due before 30 June 2021. So it's actually a time-limited expedient. And the third one is that there are no other substantive changes to the lease. So you can't use this to make other changes to the lease. So assuming that those 3 criteria are met from the perspective of the lessee, there would be no change. You don't need to look at modification. You don't need to see, do you now have a finance lease? It is specific to lessees only, so lessors don't have the same accommodations. So for a lessor, what they would need to look at is the couple of things that I mentioned when I was talking about the modification. So principally looking at what are the economics that you had before or after, both on a gross cash flows test and a net cash flows test. If it is simply a movement in timing and payments, that's likely not to have an impact in terms of revenue recognition. You would have a higher balance that you'd need to assess for loan loss provisioning, however. But if you're getting into a change of the economics, or particularly a significant change in the economics, you're then looking at the pre-COVID accounting in terms of either modification or derecognizing and starting again.
So if my September rent is only paid in April next year, I can still recognize that as income in September?
So long as you're just changing the timing, yes.
Okay, all right. Then also a question for Ronan.
Because you still expect to get...
You mentioned that the lessor would have to do some scenarios in their analysis, but at the end of the day, it's only one set of accounts that will be published, right? So which scenario is the one that is being retained? For example, do the assumptions that go into these scenarios, do they need to be supported by independent opinions from appraisers and so forth?
So the way the scenarios would work is typically you'd assign different weightings to your scenarios. So you'd have your base case, which you may decide is 60%, 70% probable, and then you may have an upside or a downside, or potentially a downside and a severe downside, which you would then apply weightings to. So long as the overall weighting comes back to 100%, you'll still be able to use that in terms of the preparation and the assessment of impairment. The reason for the scenarios is in some instances there may be just some uncertainty as to how a judgment is actually going to resolve. So by actually modeling the different potential outcomes, it gives you a kind of a greater variability and arguably just a more accurate way of just assessing the impairment and the impairment calculation.
Right. Okay. And last question. If you're required to take impairments, if circumstances change down the line, can those impairments be reversed?
It depends on the gap you're under. So in certain cases they can, in other cases they can't. However, you can never reverse an impairment back to a higher position than you would have been had you never been impaired. So just to put a real life example on that, let's say you have an asset of 100 and you're depreciating that 10 a year. You take an impairment after year 1 to bring it down to 60. And if you're reversing that in year 2, it can only go back up to 80, which would have been its amortized cost or depreciated cost if you hadn't taken the impairment. So you don't get the full reversal. Even if you get the reversal, you have to take account of what would have happened if there hadn't been a reversal.
All right. So, Ronan, Brian, and Gavin, thank you so much for this, and everybody who dialed in to listen. Thank you, and see you back again on the 15th of October with Shannon Ackert and Aircraft Maintenance. Thank you. Bye-bye.